You are listening to Demystifying Organizations. In partnership with McGraw-Hill Education, I'm your host, Jeff Shatton. My guest today is Josh Wolfe. Josh is the co-founder and managing partner of Lux Capital, a billion-dollar venture capital fund that invests in emerging science and technology ventures at the outermost edges of what is possible. Josh is a columnist with Forbes, an editor for Forbes' Wolfe Emerging Tech Report. He has been invited to the White House and Capitol Hill to advise on nanotechnology and emerging technologies, and a lecturer at MIT, Harvard, Yale, Cornell, Columbia, and NYU. He is a term member at the Council of Foreign Relations. I'd like to welcome Josh Wolfe to the podcast. Josh, thanks so much for joining me.
Thanks for having me.
Can you give me a bird's eye view of the VC space in 2020? I mean, where are we in the market cycle? Are you still finding opportunities out there? And I guess, what is your overview perspective, let's say, for the next 5 years moving forward?
Well, there's always a ton of opportunities. It's the nature of the landscape changes. And so I think this year is one that I've been harping on, a theme I call illiquidity, where for the past few years you have had an abundance of cash flowing into venture. You've had seed stage guys, you've had late stage guys, you've had corporate VCs. People have been leaving jobs and starting venture funds. So the capital formation has been enormous. The abundance of capital is high. And therefore, the scarcity of returns is likely to also be high. Usually, whenever anybody is forecasting any given sector, they show all these great, consulting company-driven exponential growth curves. By 2025, this market is going to be X billion dollars. And the thing that is determinant of returns is never any of those curves. It's always how much capital is flowing into a sector. The more capital that flows in, the higher the valuations, the lower the expected returns, and the inverse holds as well. So I think we're at a time right now where you are seeing, for the first time in many years, a pullback starting from the public markets, where the private guys were basically saying, you know what, the public markets are starved for growth. You have low interest rates, and there's a demand to fund anything that is growing. And whether it's been Uber or Lyft or some of the direct-to-consumer brands, or now Casper's filing its IPO, WeWork, of course, being the poster child, everything that SoftBank has funded. You're seeing now a scrutiny of the fundamentals that growth at any cost and unprofitable growth is now undesirable. And so if your buyer of last resort was late-stage private player like a SoftBank or a growth crossover fund, and now your buyer of last resort is the public markets are saying, no, thank you. I think there's a reckoning that's coming. So I think that all the capital that's been raised, there's going to be this retrenchment, and I think there'll be a resetting. I think there'll be a disappearance of probably hundreds of venture funds.
Yeah, there were apparently, I think there was like 800 launched last year. I was just reading there's $130 some odd billion invested in by venture capital funds in the past year.
It's a lot. It's too much, and part of it was based on a narrative which was not incorrect, but was impossible to pursue in my view. And that was a narrative by another famous VC who said, there's only 10 or 15 companies that matter in a given year, and that's true. And therefore, the price that you pay for those companies doesn't really matter, because the truth is, if you would have invested in Facebook at a $5 billion or $10 billion or $50 billion valuation, it didn't matter. You would have made a lot of money. But the problem is, for every Facebook, there's 1,000 companies that are not going to be Facebook. And so the result of that narrative was a decline in the discipline that people were giving to the prices that they were paying. Valuations got inflated. And now you have a situation where I think there's just going to be, an absolute bloodbath.
And do you think some of this has been perverted by the fact that Facebook and Amazon kind of gave us the idea that you can endlessly put off profits, right? And for a while, it's even gotten into endlessly put off revenue. But for Facebook and Amazon, they were not profitable forever, and then they turned on the money spigot and turned out to be $500 billion, trillion-dollar companies. Do you think that's perverted the idea for every other company that actually the only thing that matters is revenue and profitability doesn't matter?
Well, Amazon, there's a slight nuance that I would quibble with in that on a GAAP accounting basis, you're absolutely right that Amazon was not profitable. But remember, the only capital that Amazon ever raised was in its IPO. Now, you can point to stock-based compensation, which would be a fair thing to point to. But they did not tap the capital markets since their IPO in equity. They did debt deals. But the important thing is, well, where did all that capital come from? And the answer is they were really cash flow positive from very early days. And so I think Jeff Bezos took a playbook from John Malone, which is, you don't need to cut the government into your business if you don't have GAAP accounting profits. But if you're generating positive cash flow and you're reinvesting that cash flow into growth, you can crush it. And that's what they've done. So saying that Amazon wasn't profitable is, technically true, but it's really a different story. If people follow the Amazon playbook,
so what you're saying, so let me just interject. So what you're saying is that Amazon basically was just putting off taxes. That by endlessly growing, they didn't have to ever pay any taxes. That was a net benefit for them in terms of being more competitive for their competitive advantage.
Well, they did pay taxes. They paid less taxes, but they importantly, and this is the distinction, you can either grow if you need to consume capital by internally generated capital or externally raised capital. And so a company like Tesla generates no internal capital. They have to constantly go out to public markets or debt markets or find interesting financing schemes to finance the business. Same thing for any of these private companies. If you're burning cash at a prodigious rate, either you need to generate the cash internally from profitable operations or cash flow positive operations, or you need to rely on the kindness of strangers. And the kindness of strangers has been there for the past decade. And now I think people are being a little less kind.
So what's this bloodbath going to look like?
I think, you'll have a fraction of the number of companies today that are quote unquote unicorns. You will have a resetting of valuations. You will have a lot of people that are holding zombie shares of companies. You will have employees that suddenly look at the promise and the narrative that they bought into, and stock options that were issued at prices that are now far underwater. And they'll rationally evaluate, do I want to stay here, just as an analyst at a hedge fund that's massively underwater, or do I want to go to greener pastures? So you're going to have...
So are the greener pastures going to be just back to conservative companies working at
for some,
Deloitte, McKinsey, Goldman?
For some. I mean, if history doesn't repeat, it rhymes, and that certainly happened in the dot-com bubble. You had people that were quitting their law jobs and their banking jobs and their consulting jobs and doing startups because they saw their friends who, frankly, were probably less intelligent than them in many cases. And they said, my God, if she can do it or he can do it, I can do it. And so you had this just absolute flood of talent seizing the flood of capital. Now, if the capital dries up, then people go back to, the safety of the motherships. And so, I think you would see, record numbers of people going back into law firms and consulting firms and banking, and that will ultimately suppress bonuses and wages there. I think you'll see record numbers of people going back into academia and, applying to business school and trying to find shelter and safety there. So that's part of it on the human capital side. But I think you'll have savvy, well-funded public companies say, you know what, instead of, having to do our own internal R&D, they're going to buy some really interesting things and they'll be able to do it at deeply distressed prices.
Has that in some ways been the model today? I mean, for a lot of companies, right? It's so complex to predict what technologies are going to be relevant. So is that somewhat the role that they view acquiring a startup already?
Well, it depends on the company. You've had probably record capital formation in corporate venture capital, meaning, people maybe dabbled a little, or maybe the pension or corporate treasury was an investor in some LPs indirectly, in venture funds indirectly as LPs. Then they said, wait a second, why don't we do this direct and strategic? And so they stood up their own corporate venture capital arm. And usually it is perfectly counter-cyclical indicator. When corporate VC activity is at a peak, it's almost very indicative of a late cycle part of the game. And so I think you've seen that. What follows is the board saying, wait a second, these things are not paying off. We're taking big write-downs. It's going to be a hit to earnings. Let's divest of these things. So they go to secondary funds who are in the business of providing liquidity to get people out of illiquid stuff, and they do it at discounts. And so I think you're going to see that. On the other hand, you have people like Amazon who typically have a barbell acquisition strategy. They'll either buy something at $100 million or over $1 billion, rarely in between. When they're buying something for $100 million, it's sort of a creative technology tuck-in. It's a team. It's an interesting experiment that they want to try. If it's over $1 billion, they're typically saying, we think this is a category-defining thing. So over $1 billion for them was when they bought robotic capabilities for their factories, where they bought Ring, as a channel into direct-to-consumer for homes, and sub $100 million of these sort of cute tuck-in acquisitions.
How are you positioning yourself at Lux for the what you call bloodbath?
Well, the best thing that you can do is just have ball control and making sure that your best companies are well capitalized and the ones that you believe in can withstand having to rely on third-party financing, can have balance sheet strength to be able to take advantage of competitors that might be struggling, either as an off-ramp for their employees or potentially as joint ventures or acquisitions or mergers. So you just want to be well capitalized so that you have the ultimate thing, which is optionality. On the other end, we have part of our strategy that we call special situations, which is how can you still underwrite? When we invest in a company, we're saying can this company be 10x what we're paying in 5 years or less? And we're okay investing in a late stage business if we can still get 10x in 5 years. The situation where that would occur is because somebody else took the risk and maybe undercapitalized or underestimated how long something would take. And there's an opportunity to basically recapitalize the companies. And so you can refresh management, make sure that they're in it to win it. But typically the old investors are, getting washed out or only have a fraction of what they had. And you can underwrite.
Meaning you're going to buy shares once they've come back down in terms of their valuations?
Or in some cases, you're going to set the valuations to something that you think is underwritable.
Yeah, got it. I guess turning to another topic, what do you think are the lessons from the SoftBank WeWork debacle?
Well, I think we're still going to learn them because I think it's still playing out. It's a chapter, but the book isn't closed. There's a possibility that there's a turnaround. I think it's improbable because I think there's a narrative that is starting to shape, and the narrative was something that was not being spoken of at all, and it'll probably, like all narratives, get extorted, the other way. So what SoftBank came in as was, here's this 800-pound gorilla that has the biggest, boldest vision that you can imagine, and they're going to write really big checks. They're going to pick winners in markets. They're going to make almost Solomonic-like splits, meaning they're going to enter a market and say, we're going to go into ride sharing, and we're going to pick either Uber or Lyft, fight. And they're going to have the top players in the market competing for the benighted bestowing of the provision of their capital. And that happened with Uber. Then I think they built a portfolio of companies that, on the one hand, you could argue, had interesting growth prospects. On the other hand, also seem to have high growth but negative gross margins and really low governance. And you've heard now a lot of stories that have been publicly reported about SoftBank coming in saying, think bigger, spend more. In some cases, the founders either did or were encouraged to take on debt, which on the one hand aligned them with SoftBank to have ever higher valuations. But on the other hand, he sort of imperiled some of the decision making. I had a more conspiratorial view that I thought that SoftBank was using the Vision Fund and some of the valuations which they were propping up themselves and basically doing up rounds at their own underwriting to create an asset that could stand up against a huge amount of indebtedness of the mothership, which is SoftBank, which has an excess of $160 billion, $180 billion consolidated debt. And so that was the kind of recipe or cocktail that would, create bad behavior. Now you've seen it with the shakeout of Uber, of WeWork, now of Oyo, Wag, many others. And you're now hearing stories, and this is where the narrative is starting to swing the pendulum far the other way, of SoftBank walking away from term sheets that they've issued to growth companies. And that'll be their death knell because it's one thing when you're falling over yourselves to compete for their money. It's another thing when your board is starting to say, do not spend time with these guys because they're going to string you along and then pull a term sheet at the last minute and then you've been beholden to them. It's a different kind of leverage in the opposite way. And so I think the zeitgeist and the sentiment is starting to really sour on SoftBank. And so they'll need to be probably a management shift. They'll have to be a public commitment to investing. They'll have to do a few good deals, and they'll be able to turn it around, I think. But right now, there's more people afraid and avoiding their money than desirous of it.
Interesting. I mean, but when we think of someone like Adam Neumann, right? So one of the things that makes him compelling and several of the others is that the skills that make for a good pitch for startups, they often also coincide with the same skills for who would be a con. And I mean, we could look at Theranos. I'm screwing up the name on that.
Theranos, yeah.
Yeah. And so how do you separate the cons from the legitimate entrepreneurs? And
in the early days, I actually think if you are intellectually honest, it's impossible. It is impossible to know at the moment of inception or conception whether you are investing in somebody who is really ambitious and naive or knows with bad intent that they're pulling one over. It's really hard because you're right. The characteristics of the person, they have a magnetic, charismatic, charming personality. They get people to part with whatever job they have to join them on a mission. They get investors to part with their capital, appealing to greed. It's really hard. Now, the mistake that so many people make is that the great virtue of venture is that you get to invest to milestones. So you say, how much capital is going to accomplish what in what period of time? And you get to hold people accountable. In a rising market where you had FOMO, fear of missing out, very few people were held accountable. Now, I call it SOBs, shame of being suckered, increasingly.
Yeah.
That means you get a lot more scrutiny. And scrutiny is what holds people accountable. And
so walk me through that process. So you have a deliverable, or you invest a set amount of capital. You set out a deliverable. How do you hold a company accountable to that when you are often a minority shareholder? You don't have the kind of public accountability with that we would have with a publicly traded company. How do you hold them accountable to their deliverables?
Well, while you don't have public accountability, you actually have real high signal accountability. What I mean by that is if Lux is a lead investor in a company and we say, this is the milestones in your Series A that we expect you to hit. And then when you go out and raise your Series B, we'll be either an anchor investor in that or we'll do our pro rata. But if somebody says, oh yeah, we're gonna do all the market research, we're gonna launch our alpha or beta of the product, and I'm just talking in generic terms here. We're going to set up distribution channels, okay. Now, if you do none of that, and they say, you know what, we burned through our cash, but we're going to go out and raise a Series B. Well, we would say, on what basis? We're not going to go and bring our peer VCs and vouch and put our credibility on the line to say that they should fund you. And so, you know what, we're not going to participate in that round. You failed to hit your milestones. And so while they don't have public accountability in terms of, audited financials or the stock market, I mean, it's almost a more troublesome thing because the optics of their lead investor, who arguably would know the most, electing not to further participate could be a death knell. In fact, sometimes when we do seed investments into companies where our conviction might not be that high, but we really love the person, we love the mission, and we just want to seat at the table and we'll make a small investment in the hopes that we will write a big check, we actually tell them, don't publicize that Lux is an investor because we don't want it to be any signal value one way or the other. We don't want to necessarily attract, competitors that think that we're any kind of positive sign. And we also don't want to be a negative sign. While a private company doesn't necessarily have the public market accountability, it's actually almost more salient when we're a small investor in them at the early stages and either, they're going out to do their Series B and they've not hit their Series A milestones and we're not stepping up. Everybody else that's looking is saying, well, why isn't Lux investing? And that's true not just of Lux, but of, anybody who is an early lead investor. What do they know that is telling them not to invest? So I think the best way to hold an early company accountable is the signal value of the existing investors that are either signaling support or reservations. And the same thing when we make a seed investment in a company, it's a signal, positive or negative. We often tell the companies, you might not want to disclose that we're investors because on the one hand, we would prefer not to be disclosed because we don't want to attract attention and competition from somebody else who might say, oh, actually, it's interesting, Lux is in, so let's try to lead the next round and preempt us. But on the other hand, if we end up not stepping forward and writing a bigger check when it's time to raise their Series A or the next round, then it would be a negative signal. And this way they can just sort of position it accurately that we were a small seed investor, but just didn't step up in the A.
How do you address sunk costs? So you've already invested in a project, and you're trying to, obviously if it's a complete failure, you're not going to, and they've completely missed their deliverables, you're not going to go into the next round. But how do you approach it when it's kind of borderline, and you're struggling to figure out whether to make further investments?
Well, it's an art, not a science. The first answer is it's good to have a partnership, because it's very hard to fight sunk costs and the biases that you have as an individual, particularly when you have a relationship. As a board member with a company, you're supporting a founder, you're talking to them daily or weekly. It's very hard to then say, wait a second, I'm really disappointed, because you develop a friendship.
Right.
They're in the trenches. So having a partnership is important, because you're accountable to your partnership, and your partnership holds you accountable and keeps you honest. So that's the first thing. The second thing is we do on a quarterly basis. What did the company say that they were going to do? And then we look back, in the next quarter, did they do it? And even though I might have a narrative, this guy or this girl is amazing and they're doing so great and they're hiring incredibly well and they just won this award, and none of that might matter, because they might be missing all their milestones, and so the partnership holds you accountable. So there's a trickle down of accountability. Partnership holds the individual partner accountable, the partner holds the company accountable, and the more clear, honest, transparent messaging that there is, the better you are. So if it's me and I'm really excited about a company, but they're now 2 quarters in and they've missed their revenue, I'm having a conversation with the CEO, saying, listen, our partnership is tracking this and I'm losing support internally. And so the more honesty
that gives you some distance to the relationship, right?
I wouldn't say it's distance, but it gives you a principled framework that transcends the personal. And it's like, at some point my hands are tied. I love you. I want to back you. I want to see you succeed. But the performance is not there, and I don't have the support from my partnership. So yes, your hands are sort of tied.
So then, what do you do if you have a crappy CEO? Like, you have a really good company, the product might be good, but you lose faith in the CEO.
I mean, that is really the single biggest thing that I learned early on, which is I always thought that I would be advantaged as a venture investor discriminating amongst the best technology or figuring out the market. And there are some investors that say that, right? And it works for them. They don't take market risk, or they don't take technology risk, and we'll take both. But it's the people. The number one thing that matters are two-legged mammals, and it's their ability, in one case, to be able to raise money, in another case, to operate the business well, to develop credible reputation relationships with vendors, suppliers, the media, HR, IR. We have never, ever parted ways with a CEO or made a transition where we didn't ever wish that we would have done it later. Every time it's, we should have done this sooner. We have gotten really good at having conversations early. Obviously, every person is uniquely different. Some people, it's their baby. The idea that you're telling them that they need to leave the house that they built is appalling. And so if you can do it.
Well, so how do you identify that? That it's time to part ways, and then how do you put the decision mechanisms in place so that you can do that in a timely manner? Again,
this is good governance. So there's let's take 3 examples. One is the easy one where CEO does something wrong. I mean, that's easy. There's bad behavior. It's just that's just a process thing. So you just you deal with it with dispassionate but swiftly as you can. The second thing is let's say there's an internal coup, and employees might come to you as a board member or an investor, and you hear rumblings. And it's important that we not only interface with the CEO, but you're talking to the CFO, you're talking to the next layer of management. On the one hand, because some of those people are going to go off and start businesses, and it's in our interest to really be close to them and be seen as a good partner. On the other hand, because they're a source of honest info, they might feel suppressed wanting to share something in a boardroom with the CEO, but if you have a relationship with them, you might get a hint at something. So, we talk to head of HR, we talk to CFO, we talk to CTO, head of engineering, head of product, and so on, marketing. But let's say that you hear a rumbling. Somebody might say, it's her or me, or it's him or me. They got to go and you get that ultimatum. Well, then you try to work out, okay, what's the real dynamic here? Is there some sort of power struggle? Is somebody not feeling like they're being valued the right way? Is it resolvable? And we've had a few instances where people have said, like, I cannot work for this person anymore. And then you end up, you do 360s. You try to do it certainly on an annual basis, but, sometimes with greater frequency. And you coach the CEO and say, your people are sort of revolting. And if they really care about the business, we've had a situation where in multiple cases, the CEO didn't have the confidence or faith in their people. It was their baby. We didn't want them to walk, away losing pride feeling disgraced. And so you find a role for them. They might stay on the board, but they help to find their successor. The third case is one where the person was the early visionary.
We want to go back to the second one. Have you been able to coach a CEO into changing their behavior and regain the trust of their employees?
In some cases, if it's isolated to one or two relationships, yes. If you have, an entire group of employees that, it's too hard to change the perception. It's not like somebody's like, I just went on some vision quest and I came back and I'm a changed man.
Right, sure.
If they have tension or there's an issue with, I've had one where I coached a CEO and a CFO where the CEO was frustrated because the CFO was being very dogmatic, very detail-oriented on the numbers. He was going out trying to raise money. The CFO felt that he was misrepresenting what the future could be. He felt that he was just talking about, what his vision was. And so there was this tension between the CFO who was meticulous, the CEO who was trying to tell a story, and the gap between the future and the present. And you had to sort of, let them understand each other. What made the other one feel uncomfortable? And so that ended up getting resolved. I find that if the CEO's got an issue with one or two or three people, it's resolvable. If it's an entire team that has cast out, it's really hard to change.
Right.
The third instance, which is sort of related to it, but it's the one that's probably been the most frequent, is you have somebody who's well-intentioned, they're good, they're liked, and the team might not see this except for the results. They can't raise money. They go out to market and they're just falling flat. And we've done some CEO changes with that. In that case, you have the conversation. You say, listen, you're going to go out and you're going to raise your Series B or C or whatever it is, and you got this target, and you've got our support, and we're going to tee up introductions. And oftentimes when you have good relationships with peer VCs, they will come back and say, listen, we really love the business, but we couldn't really get our hands around so-and-so as, the full long-term leader. What are you thinking? He's in the seat for a long time. And when you get that kind of signal, they might be giving it to you diplomatically. And then you get to give it diplomatically and directly to the CEO. Listen, people just are not really willing to bet on you right now. And that's an opportunity where we've seen CEO takes a role as an exec chair or maybe a consultant to the board and to the business, and they work with us. And we've had 3 or 4 really great transitions where they were treated with total dignity and respect. They hired their successor. They didn't undermine that person. It's usually often a bad situation if they stay on the board because the new CEO is sort of reporting to them, as in a governance role, and there's just too much ego. But we've seen a bunch of transitions where expectations were clear, good, honest communications. It worked out well.
Yeah, it seems like an impossible task, right? Because you have somebody who has started a company, it's everything they've put their entire life into, and then they need to go take a back seat.
But at the same time, they want to see it succeed. And so when faced with the choice, which isn't always necessarily binary, but would you rather see this fail, or would you rather see this have the chance, success, not only for, your legacy, but, presumably you have a lot of net worth wrapped up in this.
So you do, many of the companies that you invest in are pushing the realms of scientific discovery. And so I was wondering, how do you predict human progress? How do you decide what areas of progress are the most likely to continue in their trajectory? New areas of human progress that you don't see coming. How do you view those areas?
So it's interesting because you say human progress, and I actually think that human nature is a little bit easier to predict than technological progress. And so, technological discoveries almost by definition, particularly scientific-based technological discoveries, almost happen by accident. The greatest discoveries through history were always preceded by the words, that's funny. Somebody just sort of stumbles upon something. Human nature is a little bit easier to predict. And so I read a lot of evolutionary psychology and anthropology and understanding people. I think Jeff Bezos, who I consider a great technologist and a great engineer and, very fastidious and meticulous in his process, has a phenomenal framework. And he says, look, I can't predict what technology is going to be 5 or 10 years from now. I have no idea. There's so much uncertainty. But I can predict with absolute certainty that 5 or 10 years from now, people will want more choice, not less. They'll want cheaper prices, not higher. And they'll want more convenience, not less. And so when you understand the sort of timeless things that people are going to want, people want social status. They want convenience. They want choice. They want things faster. They want to be entertained and enthralled. It just leads you to these sort of what I call directional arrows of progress. And
And then how do you layer the technology on top of that? Because you invest in companies that seem like sci-fi crazy stuff out of books and movies.
Yes. Well, in fact, I would say that sci-fi and sci-fact gap is shrinking, and either our scientists and technologists and engineers and inventors are becoming way more creative, or our sci-fi authors are becoming less creative. But I actually, it's more the former. But almost all of our engineers and founders are to a man and woman inspired by sci-fi, and they saw something when they were a kid or teenager, and they said, like, I want to live in that world. I want to create that world, and it's a beautiful thing. We have these two arrows of progress. One is this idea of the inevitable, and you can just sort of look over the arc of history, and you can see that there's an inevitability of some directional arrow of progress. I'm looking out the window now as we're talking, and there are cars on the street. And the history of transportation very clearly went from horses to horse-drawn carriages to cars to manual cars to electric cars and now to autonomous vehicles. We are not going to go back to streets filled with horses. In the situation of lighting, we went from torches to an incandescent bulb to fluorescent lights to LEDs, and we're not going back to sconces on walls, with fire. And so there's certain directional arrows of progress that almost follow principles of physics, of more and more energy or information or physical matter density. And so, in memory storage, you're going to go from spinning disks to solid state storage, and the same thing in microprocessors. And so when you spot those arrows of progress, it sort of points you in the general direction, not to the company, not to the entrepreneur, but in the general direction. And then when you can map onto that, the idea of the impossible. So if the first is the inevitable, when the inevitable meets the impossible, what's the impossible? The impossible is when everybody thinks there's no way that thing will ever work, which by definition from an investor market perspective means that they're undervaluing or underappreciating it.
Can you give an example?
Probably the most recent is a company that I was really obsessed with. We became a lead investor. I became a board member, and I begrudgingly voted in favor of selling to Facebook, which was Control Labs. This was an inevitable arrow of progress of the way that we interact with our computers. You went from a giant ENIAC computer that you stood up and pulled plugs and levers, 50 years ago, to a desktop computer 25 years ago with a mouse and a keyboard, to 12 and a half years ago, laptops where they're physically touching your thighs, to 6.25 years ago, the iPhone that was the dominant form, the first thing you touch in the morning and night, and swiping and pressing and touching and zooming. And then 3.5 years ago, your iWatch, and then a year and a half ago, AirPods with now compute inside and voice recognition. The undeniable arrow of progress, that inevitability, was that our computing was becoming more and more intimate with us and more natural. The technology was becoming more sophisticated, even as it got more invisible. And I was convinced that the next wave of the way that we would interact with our computing naturally would become gestures, that we would effectively be using our body in three-dimensional space to conduct the world around us, to point at a light and be able to just make a gesture to turn it up or down, to point at a speaker and be able to just, raise the volume or swipe to the next song in free space in the air without a camera. And as I shared that crazy idea with people, they told me I had to meet this particular entrepreneur, Thomas Reardon, who goes by Reardon. And he was just an exceptional guy. He was scientifically obsessed. He was Bill Gates' right-hand guy for 10 years in the 90s. He helped create the Internet Explorer program and was like the first, engineer coder on it. And he saw what happens when you take a product, that comes from imagination and you scale it to 1 billion people. He ends up getting a college degree in his early 30s, getting a PhD in neuroscience, and his pioneering work was around myoelectric response, which was measuring the electrical stimuli from the muscles, particularly in the arm, that could be decoded like a signal by wearing effectively just an armband using EMG. It was like magic. I put on one of these bands, I'm typing on a keyboard, and he pushes the keyboard away, and I keep typing, and the words are popping up on the screen.
But nuts! You're actually moving your fingers, or you're thinking of moving your fingers?
Well. So the first part was moving your fingers, where there's no device. I'm not pressing a remote control. I'm not turning a Nest thermostat. But just by doing that kind of thing with my hand in the air, I can control the thing. But
so like the Nintendos and some of the game systems.
Yeah, but without any sort of infrared or cameras, right? It was just it was reading. Your brain was telling your muscles to move. Your muscles moved and normally pressed a button on a keyboard or a remote, and instead the mere act of your muscle moving was mapped to those buttons, and so you could just the device was you. Now, to your first part, which you perceptively picked up on, you can then the next step, which was the crazy, is without actually moving the finger, without physically kinetically lifting it, which scientifically here, you are activating thousands of neurons to lift a muscle. There are about 15,000 neurons in your forearm to your hand that innervate, connect to about 14 muscles. And so if you're lifting one of those muscles, there's a few thousand neurons that are lifting it. But if you just think about lifting that muscle, if you think about lifting your finger, and if you actually try this, you put your hand on the table and you think about moving your pinky without actually moving it, you sort of feel a sensation in your pinky. That sensation is measurable. The sensors are strong enough to detect that you are thinking of moving your pinky. And so without even moving your hand, you can play a video game, you can control Spotify, you can type, and that is like magic. And, as the famous Arthur C. Clarke quote went, that any sufficiently advanced technology is indistinguishable from magic. And
that is magic.
It is magic. And so that was an example of the inevitable, this directional arrow of progress of how we will interact with our computers, and the impossible. Somebody would look at that and be like, there's no way that works. And then they experience it, and you have this, oh my God, that's insane. So, yeah, we were in that company for maybe 2 years, and Facebook bought it for a little under $1 billion.
Wow. And you regret it?
I regret it because I think it should have been over $10 billion. I truly believe that I absolutely love this entrepreneur and the team that they assembled, Reardon and Patrick Kaifosh and Josh Dewey. And these are just incredible people. And, Facebook's history is whenever they make an acquisition, people scratch their head and say, my God, I can't believe they just paid X for that. And within 2 years, it's very obvious that they massively underpaid.
Yeah. And is part of it that you want to still be part of it? And, not have it in the kind of Facebook world in that system?
I actually think, morally, I think Facebook will find its way over, the coming years. But I think the idea to continue to be part of how this is going to really transform lives, something special. And I'm friends with the team and the founders, but so one of that is being there in the room when it's happening.
Because at some point it's got to be less about making money. Like to me, if you're involved with something like that, the excitement would be so much more enticing than eking out a little more money.
Well, I'm in the business, and I'm very fortunate to get to do what I do because we make our LPs money. But it is about making our investors money because those are foundations and hospitals and children's hospitals and endowments but there is a great satisfaction of investing in things that we say matter, that matters, things that we think are meaningful. But to be in a room where a technological or scientific secret that the rest of the world doesn't know, and they won't know until you or the company tell them, is a very powerful feeling. And it's an addictive one to find something that nobody else knows about yet. It's the same thing like if you heard a band and you're like, oh my God, these guys are amazing, and know that they're going to be a big deal. It's really powerful.
All right, I just want to ask one more question. This has been really amazing. Which thinkers do you admire most that you turn to? I don't care what the topic is, but just the thinkers out there that have pushed your own thinking.
Well, I like people that are intellectual polymaths because they, reach into different disciplines. I love Michael Mauboussin. He's a good friend. He chairs the board where I'm a trustee at Santa Fe Institute. I think he's a real, sort of many world thinker, just looking at different disciplines. I think all the people at the Santa Fe Institute really embody that, whether, Bill Miller, who's another investor, or David Krakauer, who runs the place. Bill Gurley, I think, has just incredible instincts as an investor and great ethics. Charlie Munger, for me, has been a long time, what Ben Franklin was for him, Charlie is, I think, for a lot of people. And I think that idea of just being a rational, intellectually curious person. Danny Kahneman is a friend. I've been very fortunate to know him and having an appreciation for our cognitive biases and thinking about how we think and make decisions and the noise inherent in some of those things and the randomness. Nassim Taleb as an author is an insufferable voice because he's so condescending to people, but he's got a lot of good ideas.
Such an ass.
He is. But it's a shame. But I think a lot of their ideas for me very early on.
Brilliant.
Low probability, high magnitude events. Tyler Cowen, I think, is a really interesting.
He's a great podcast.
Yeah, and just a very thoughtful. I wouldn't even really consider him an economist. I think he's just a interesting human. So yeah, those are a few.
All right. Well, thank you so much. This has been a real honor to have you on.
My pleasure. Thanks for having me.
Thanks for listening to the podcast today. If you have any questions or comments, you can email me at jeffshatten1@gmail.com. You can tweet me at jeffshatten. If you like this podcast, press the subscribe button and make sure to rate it on iTunes so that other people can find it.